The Russell 2000 falling as the pullback from the post-election rally continues. Small caps down over 4% in the last 5 days as concerns over higher for longer rates set in. The next key catalyst for investors will be Nvidia earnings out tomorrow. So what could the results mean for the rotation into small caps? Joining us now, we got Mike Reynolds, the Vice President of Investment Strategy at Glenmede. Mike, always great to speak with you. I know you've been more bullish on small caps for a little while now. If we do get a disappointing result for Nvidia, is that going to be enough to turn around some of the downward pressure that we've seen in small caps lately?
Thanks. Happy to be here. Our perspective on small caps is that we have really these dual tailwinds right now of fair valuations and earnings growth expectations that are really expected to pick up into 2025. Now, we think small caps have pulled back a little bit on expectations that the Fed's going to be a little less aggressive on its rate cut campaign. We think that that's rate cuts that are likely postponed, not just canceled. Overall, we think our thesis on small cap outperformance over a, call it medium to long-term range is still relatively intact despite some of these near-term headwinds.
Mike, what do you think the earnings growth trajectory is going to look like for small caps when you compare it to its larger cap peers?
Yeah, going into 2025, we're expecting some pretty meaningfully better results, 20% plus, whether you're looking at the Russell 2, the S&P 600, versus closer to 10% for the S&P 500. This comes after a period of a couple of years where small caps just pretty serially under-earned relative to their larger counterparts. And we think there's a catch-up here. We think we're starting to see the early signs of it. We may even see some really early signs of it in Q4 earnings season, so we're watching that really closely.
Yeah, what is the biggest driver of that turnaround story, Mike? You mentioned earnings prospects. Where are you seeing evidence of that growth kind of across the board versus just in individual names?
We're seeing it pretty much across the board. And look, we think it's a relative game here versus the largest of the large and the small companies. You know, I'm a big fan of the show. And Madison, I heard you refer to the bond market as a stable boyfriend not too long ago. I actually want to take that analogy one step further. From our perspective, the Mag 7, which have really been driving this market, are kind of like the guys with a few red flags, but the girls seem to chase them anyway. I think investors are starting to ask themselves what sort of earnings growth expectations are built into those premium valuations and whether it's reasonable to attain those. Take a look at the flip side on small caps, and you've got really decent valuations, really right at fair value from our perspective, where it actually just doesn't take much to get over that hurdle to see them outperform once the earnings and the underlying fundamentals start to improve going forward.
I guess then my concern, Mike, is what if we don't get that earnings growth moving forward? What happens to small caps then? Would it be relying a little bit too heavily on a Fed that might be impacted by an incoming administration that could change the path forward for rate cuts?
Yeah, again, the thesis for small cap is underlying, underpinned from both the earnings and the Fed sort of impact from lower rates. From our perspective, small caps are much more sensitive to Fed funds. In particular, their debt stack is much higher in floating rate coupon debt, which should be more directly sensitive to the Fed's rate cut campaign. And look, again, we expect the Fed's going to be less aggressive on the rate cut campaign going forward than perhaps we had expected just a month or two ago. But the fact of the matter is we think that Fed funds is still on a real basis materially too tight. Now, does it mean we get to neutral within the next couple months? Probably not, but we think the Fed is going in that direction. Investors that sort of have the patience to play this over the longer term, we think are really going to be rewarded here.
Mike, I'm curious just to bring you back to some of the movement that we're seeing here this morning. Clearly, we're looking at a bit of pressure. Geopolitical risk is back in the forefront here. How are you evaluating that just in terms of how much pressure we could see on the markets here in the short term?
Yeah, in some sense, it's not all too surprising to see geopolitical tensions flare up in the lame duck session right after you have a presidential election. So historically, we would expect that this is kind of par for the course. It's very hard for investors to sort of get an information advantage around these types of geopolitical events. As an investor, you sort of need to know your limitations. If you don't have an information advantage, you probably don't want to be trading these types of events. And if you have a well-diversified portfolio, you should be able to weather these events as they sort of come to fruition and see themselves out over the long term.
And Mike, you mentioned in your notes you sent over that we are late cycle. That creates more volatility. Obviously, the geopolitical backdrop creates volatility. Where should investors be seeking some safety if they are concerned about the path forward here?
Sure. So we recognize we are late cycle. We're looking for those measures of excess that sort of tend to tip you into recession. We're not seeing meaningful signs of that right now, but you got to stay vigilant in this sort of environment. You have to sort of be selective with the bets you're taking in your portfolio, avoiding some of the most expensive names in the equity markets, but also opportunistically playing some foreign markets that we think are materially underpriced. In particular, Japanese equities. We continue to see ongoing governance tailwinds, and perhaps even the currency could be a tailwind for US-based investors that don't hedge their exposures. So it's really selective bets you need to be taking in your portfolio as you're in the late stage.
All right, Mike Reynolds, Vice President of Investment Strategy at Glenmede, thank you so much for joining us this morning. We appreciate it.